Welcome to, this is Bill Condon and Matt McGregor, to another podcast that we're going to do. We're going to kick things off by talking about the overall market and dive deep into the different segments throughout the Kent Valley.
Yeah, hello everyone. You can catch our podcast on Apple Podcasts or Google Podcasts. Industrialadvisors.com is our website, and we're excited to talk about the market. So let's just kick it off. So Bill, in general, how do you feel about our market?
Yeah, it's been another, I think, really good year. It seems like each year we say that, and the market continues to do great things, both from a rental growth standpoint, from a demand standpoint, and certainly continues to be a lot of capital out there chasing deals.
Absolutely. Let's talk a little bit about, I think the hot topic in our market is development and construction. Everybody seems to be chasing it. Everybody wants land. Good luck finding it. But let's talk about the numbers and then get into a little bit of commentary about where we think the demand is going to be driven from. So total numbers on construction delivered in the last 24 months is 9.6 million. And then we've got about 4.2 million under construction. But I think the theme here is what's available, what is still about 6.3 million. And that's a lot of product. The net absorption being about 3 million feet a year. So how are you feeling about the overall amount of product available?
Yeah, it is a lot of product. And what's interesting is a lot of that product is south, right? We start looking in Lacey and DuPont and Frederickson, and we're starting to see spec in those markets. And it seems like that happened almost overnight, right? All of a sudden, those markets are, markets that developers are comfortable building spec in. And we'll see how it plays out. I mean, I certainly think that, Tacoma, North, I would build spec all day long in those markets. I think Lacey, DuPont, and Frederickson, we're going to find out how those are going to perform on a spec basis.
Yeah, that's a great point, because honestly speaking, I don't think we really included those areas, saying Lacey, DuPont, and Frederickson, in our market, what we would have said a market 12 months ago. I mean, that's how quickly this has changed, right?
Right.
I feel like the floodgates all of a sudden opened up, and everybody, including ourselves, says, okay, this is now the south end of our market, where we would have all said Lakewood was the cutoff.
Right.
And as I said, we put Best Buy in Frederickson, right? Prior to Best Buy, I think somebody could have put $10,000 on the table and asked me to drive to Frederickson, and I would have failed.
Yeah.
Right?
Yeah.
I
might
you.
still. Yeah.
Right?
But
you're not alone.
It's interesting because it kind of reminds me of Sumner back in 2004, 2005. I mean, that was pioneering at the time.
That's right.
And
Good job,
now
Bart.
you have, exactly. Pantone did a great job, right? Yep. And then the others followed. And I mean, you look at where deals were getting done at that time, right? And now you look at Sumner, rents have doubled in that time period, right? But you're seeing more and more developers getting comfortable pushing south. Part of that is just that's where the land is that's left, right?
That's right. That's where it is. But the interesting thing is, okay, we've seen some, not build to suit, but, market deals going down there into speculative development. Was that because there wasn't product available? Because what we're seeing now with the Sumner Golf Course come back online, you've seen the Tarragon Greenwater site coming online. I think the Milton project with Bridge Development's going to come online, and then Weyerhaeuser site, right? To name a few. Other ones are coming online. How do you think it's going to compete now that the Valley can deliver large projects again?
Yeah, I think that's a really good point that you make. There are projects that next year, 2020, in Sumner are going to be delivered. And in my opinion, the majority of tenants would still pay more and be in Sumner and prefer to be in Sumner than they would save, 5-8 cents a square foot, whatever it may be. Maybe it's 10 cents, and go to Frederickson or Lacey or DuPont. So I think the Sumner projects will fill up quicker, and that the ones further south will probably sit a little bit longer. Now, bigger is better as you go further south, right? In Sumner, the perfect building, in my opinion, would be 400,000 square feet with a little bit of trailer storage.
Cross-loaded.
I mean, that's all day long, right? And so what's attractive to those users in those south end markets is they can go find a 1,000,000-footer and then go lease that big of a space. Now, what do you think about the tenant activity once you get above 600,000 square feet? How do you feel about, would you build a spec building that's 800,000 feet in Lacey or DuPont or Frederickson?
As long as nobody else was, right?
Right.
So as long as I was the show, I think I would. And so that's the interesting thing is, can you customize your building to be that one provider, maybe two, right? You start seeing 3-4 projects down there that are looking similar, and I would get very, very nervous. I think the question going back, so the answer to that is I would build it if I felt like I was one or two options of a unique building. So 800,000 foot cross-loaded, perfect shape building, no strangeness to it, trailer parking, not too far off the main corridors. I would build that. The question is, some of these deals that went down there, Kimberly-Clark, for example, Best Buy, I think we know the answer to that, or even the latest one with Home Depot. Would those gone to the Valley if, say, the product in Sumner was available? Would they pay the difference? Would they have?
Right.
What do you think?
I think they would.
You think they would pay up?
I think most tenants would pay up and be in Sumner compared to going down south.
Yeah, then it'll be interesting as we start to now see these projects come online that are competing size-wise, because the pricing discrepancy is 15 cents on the shell plus probably 7 or 8 cents on nets difference.
Yeah.
So it's a big difference, because at the same note, when Best Buy went down to Frederickson, they did have options in the valley.
Right.
And chose that based on the labor logistics studies and combination of real estate costs. Right?
Sure.
So
yeah, and a lot of it too
interesting.
depends on who are the customers, who are they serving, right? If it's a local play, obviously location, being close in is more important. Whereas if they're serving a couple surrounding states, being further south doesn't matter that much, right?
That's right.
So
That's right.
So a lot of it depends on that. But on that topic of the south end markets, maybe you could talk a little bit further about Frederickson, and I know you dove into that pretty deeply with Best Buy going down there. Maybe talk a little bit about your experience with that and how you feel about Frederickson as it relates to Lacey and DuPont.
Yeah, so I would say those are interesting markets, and I get why DuPont and Lacey were developed first, because they're right on the I-5. So if you're looking down the corridor, you're going, what's the next available city? It makes all the sense in the world. When Best Buy looked at it, and when I look at it today, Frederickson offers some unique things. From a labor perspective, when you do the studies, it looks very favorable. That market is also a lot bigger than most people think it is. It's 5 million feet, where Lacey and DuPont together, this was pre-Home Depot, was about 7 million feet compared to 5 million feet in Frederickson. So Frederickson individually was larger than either of those markets individually, but smaller collectively. When we looked at it with Best Buy, after I found it, right?
Yeah, right.
That took
you
a little
did the
bit.
pre-drive.
Yeah, that's
the
right.
secret pre-drive. Yeah.
It was interesting from a logistics study, because going down I-5, you got 6 lanes leaving Tacoma going south, and everybody's on it, right? We know it's a grind. If there's a wreck, you're done, right? There's no alternative option. So your labor's sitting there tallying up by the hour. Frederickson, although no road is as perfect as I-5. You have 3 exits that you can take off 512, and I think there was a total of 14 lanes over the 3 exits. So if one's bad, you have alternative. And overall, you got a whole lot less people driving to Frederickson on those Canyon Road or Steel than you do going down I-5, right?
Sure.
Heading to Portland. So the volume is less. And then you put that in with the labor studies and the cost of the real estate. That was a pretty good deal, right? Those combinations made it a no-brainer. So do I like it more than DuPont and Lacey? Look, I like DuPont and Lacey, but I would say if you're a tenant, you take a very hard look at Frederickson if you're looking at those other markets.
Sure.
Yeah.
Sure. Well, and just, to make it clear for our clients too, Matt is the expert in our partnership on Lacey, DuPont, and Frederickson, and I have everything from Seattle to Tacoma. So just want to make that clear.
That's right.
Yeah.
And speaking of those areas, the net absorption, get this, if you look back, take out the last 36 months and you looked back over 10 years, Sumner was where most of the absorption happened. About 42% over 10 years of the entire market absorption had hit Sumner. Now, if you look at the last 36 months, almost 70% of the total market absorption of new product has happened between Tacoma, Frederickson, DuPont, and Lacey, with Lacey really jumping out there at 26% of the market's absorption over the last 36 months. So pretty amazing numbers with a shift down south. But to your point earlier, Bill, where Sumner was that pioneering market, clearly we have shifted. Right? That pioneering market is now down south, and the numbers don't lie here.
Absolutely. I mean, Tacoma's 30% of that. Fife is about 15%, and Sumner is still at 15%. I think a big reason why is obviously that's where the big tenants have gone, because of that's where the land's at, right? Yeah,
for sure.
But certainly it shows that there is great tenant demand, and those tenants will go south if they need to.
No question about it. And we touched on this a little bit, but let's talk about rent growth and where we see it. With so much product going on in the south of the valley, will we see good rent growth with so much competition coming online? And where is the rent growth coming from? We've had 3 straight years of double-digit rent growth in our north market. How high can we go? Are we going to see another double-digit? What should people be forecasting? What do you think?
I think we have room. And I think that, from a location standpoint, you're seeing South Seattle push rents to $1.25, $1.30, right? Yep. I believe that North Valley has tremendous upside for rent growth. You can be in South Seattle and pay $1.25, $1.30, or you can go down to the North Valley and pay 70 cents, 75 cents. So I think that gap is too big. You can get more functional product in the North Valley. You're only 8 miles, call it south of South Seattle if you're in Renton, Tukwila, North Kent. So I think that the North Valley has the most upside for continued growth. And we're seeing that. I mean, we're seeing rental rates. I mean, I was out with a tenant yesterday, we got a renewal on 60,000 feet, and a good building, the first renewal was at 76 cents on the shell, right?
Yep.
And so that's where tenants are going to have to pay if they want to stay North Valley.
That's right. I couldn't agree more. And we've done deals, at 85 on the shell in that region. So you've seen the biggest rent growth in that Tukwila, Renton, North Kent area. And I agree. I think that's where you're going to continue to see, big numbers. The interesting thing is, and we've started to see this on a couple leases, is will people project in leases greater than 3%, right? Asking tenants. We're now starting to see the first phase of that in proposals. I won't name any landlords, but there's a big one that we've seen that on. And really it makes sense because if we're talking about double-digit rent growth for the last few years, most people would say we're at least going to be 7, 8, 9% in the next year or two. So why are these is fixed at 3%? So a lot of landlords are now challenging that, and you're seeing it in proposals for the first time. How do you think tenants are going to react to that?
Well, I think you named, a couple big landlords that do it, and it will become the norm. It was
That's
like
right.
when, office rents, right? They've gone from 65 cents to $1.10, right? In a span of 10 years, right? So the fact that increases have stayed at 3% for so long, I think that's going to change, and it should change depending on location, right? Tacoma North, I feel like you can push that, and you should, and tenants will get comfortable with it because it'll become the new norm.
Right. Agreed. And where do you see the challenges in rent growth? Anywhere going to be flat or even even dropping?
Yeah, it'll be interesting to see. I think the markets to watch will be those really south end markets, right? As we mentioned earlier, there's new product coming online in Sumner. I think that will perform extremely well. So I think Fife, Tacoma, Sumner, Valley, all those rental markets will continue to go up. The Lacey, DuPonts, Fredericksons of the world, I think will increase, but not at the rate that those other markets will.
Yeah, I would agree with that. And then what about challenges? Like what are we seeing out there? What do you think about the Kent moratorium?
Yeah, I think there's not a lot of land left in Kent, right? So I think that will continue to push rents in that market because you aren't going to be able to build, more product there. I do think that, the South Seattle market is a bit slow I know Amazon just leased the triple decker, but there's not a ton of activity in that market from a tenant standpoint. I'm hoping and optimistic that that'll increase, but I think that is a challenge that there's not a ton of tenant activity in that South Seattle market.
I agree. It's soft.
Yeah.
Yeah, I agree with that moratorium. I think that'll continue what we were saying earlier about pushing rates in the north end because you just don't have new product coming on competing, right? So you're just going to continue to see rate push because people can't develop. I mean, what is the moratorium? It's like one door per 40,000 feet.
Yeah.
So you pretty much can't build.
Right.
So with that, mostly if you're a newer asset, you're going to be that newer asset for some time until they figure that out. And so you should be able to drive very, very high rates.
I agree with that.
So with that, Bill, I think, overall, I would say the market's pretty hot still. Vacancies ticked up, but that's just because we finally were able to get a supply, right? It took a lot of years to entitle some of this land, and now the developers finally caught up. But we haven't even reached 5% overall. So I would deem it as a very, very healthy market, getting close back to some equilibrium between tenants having options and landlords still being able to push a little bit of rent, but a very healthy market.
I would agree with that. I think we've had another really good year. I feel like the market has momentum heading into next year, and I'm optimistic that we're in a really good position to have another great year from a market standpoint heading into 2020. So appreciate everybody listening, and hopefully you found this interesting. We will continue these podcasts here in the future, and so be on the lookout for our next podcast. But thank you for listening to us, and we'll look forward to talking to you guys soon.
Thanks a lot.